we have. We lodged 1 million complaints. They still haven't replaced it. Yeah, they haven't. No, and if you see that, and if you record that, it has an impact on the quality of the recording as well. So yeah, so that's pretty awful.
So I mean, because I looked in here and the battery's fine. And it's like, okay, this isn't. I've never experienced it just going in and out.
It just needs to be replaced. That's it.
So what we need to do is pilfer it from another lecture
so,
theater.
So what unit is this ready? What's this? Is it 101?
101, yeah. And I didn't want to pay for sure.
What's the point of
And this is terrible.
Oh, John. Well, I know that you look like a star, but well, to be honest, you're not.
I don't want to.
Can I lock you out, Randy, so that I can? Oh, okay. Okay. So someone is already in, so I have to lock that person off.
No, it was a student. Chris didn't tell me that this microphone doesn't work.
Chris who? Dukuleago? It doesn't. Hasn't been working for the entire semester. Class 2, but I've been lecturing in this lecture theatre in the other unit. This is Advanced Corporate Finance Master, International Finance Master. Yes, Oh, okay. Oh, thank you so much. So you from what class? Yes, 3 p.m. Okay, I made an announcement. Yes, so thank you. Good. Make sure they've got everything. Make sure they've got everything.
The only thing I might be missing is this little plastic plug that goes over the desk, but it's not exactly critical.
I think I have to get started because then I have to go on the No, I'm just kidding, but I mean, I don't want to get time.
Do you need a microphone?
Good afternoon, everyone. Can I get this lecture underway, please? Okay, good afternoon. My name is Hua. I've been, posting messages on DSO and so on, but I haven't had a chance to meet you, so I'm really delighted that I finally get to meet you in this class. And as you know, I'll be taking the last 6 lectures, so I'll be taking you through to the end of the trimester. Okay, so just a little bit of information about me. You should already know all this from the unit guide and from information on DSO. My office is right next to Michael's office. I don't know whether you've been, seeing him, but if you come and see him, then my office is right next to him, so it's very easy to find. I've got my phone number and my email address up there if you ever want to contact me for any reason. My consultation times is on Wednesdays from 10:30 to 1 o'clock. Can you just get settled pretty quickly, please? Can you just come in and sit down very quickly, thanks. Okay, Ta. I was saying that my consultation times is on Wednesdays, 10:30 to 1 p.m. But it's always a very good idea to email me before you come in because I tend to be very busy during my consultation times. So to make sure that you get to see me and to make sure that you don't have to wait, make sure that you drop me an email and I can give you an appointment so you can come in and see me straight away. Other times by appointment, obviously, so just drop me an email and I always come up with some time that is suitable to see you in the shortest possible way. So that's pretty much about me. In terms of the assessment, Michael will be looking after all the inquiries in relation to multiple choice test number 2. So that's probably one of the last things that he will do in this unit. So if you have any inquiries about that particular test, come and speak to me. Speak to him. But after that, for multiple choice test number 3 and 4, I'll be handling them. So please come and speak to me if you have any problems about that. In relation to the content of the unit, Michael is responsible for the content of the first 6 weeks of lectures. So if you have any question in relation to any of the materials that he covered, or about the assignment for that matter, he'd probably be a better person to address those inquiries. Whereas if you have any question in relation to the content that I cover in the second 6 weeks of the trimester, please come and speak to me. So that's pretty much how we divide our workload. Now, your assignment is due in slightly more than 2 weeks, so I believe that you are all busy working on that. And of course, your next multiple choice test is coming up shortly in a couple of weeks as well. So just make sure that you're aware of those. Now, I hope that you all have in your diaries the date of the 2 remaining multiple choice tests because it has never stopped. I'm so amazed that students still missing the test. I just don't understand why because this is already the second test. So make sure that you write down the dates and do not miss them. Okay? So having said that, the last thing that I would like to say before we move on to today's topic is that I have a very big favor to ask from you, and that is I have a daughter who goes to childcare full-time and I need to pick her up. So if it's at all possible, can we not have a break? So we just keep going and we finish early. So if you agree to that, I would be very grateful because I really don't want her to be there with no one to pick her up. So thank you for that in advance. And today we'll be looking at leasing. Now for the last couple of weeks, for the last at least 3 weeks, Michael has gone through different sources of financing with you. So that's the different ways that a corporation can get money to finance whatever investment projects that they have. Today we're going to look at leasing. Now leasing is not obviously, it's not an obvious form of financing, but it is also considered a form of financing. For the reason that when you lease an asset, especially a long-term asset, then you don't have to spend money to buy the asset. So in that sense, leasing is also a form of financing. So that's why we include leasing right in with other forms of financing. So in relation to leasing, what we're going to do today is we're going to look at the definition of a lease. So what do I mean by a lease? And then we'll look at the different forms of leasing or different types of leasing. In particular, we'll be looking at operating lease and then a financial lease, so the definition. We'll look at the reasons why firm would rather lease an asset as opposed to borrow money to buy asset. Why is it? What the reason that make leasing an attractive form of financing? And finally, which is also very importantly, we'll be looking at how we can actually value the lease. In other words, we want to address the question of should we lease or should we just borrow money and buy? So that question can be answered by valuing all these leases. So that's the agenda for today. So let's see how we go. So the first point, I kind of explained that already. We consider leasing as a form of financing because by leasing long-term assets, the company does not have to raise money to buy the asset. So in that sense, it provides financing to the company. Now, so what is a lease? A lease is pretty much a rental agreement. So you have 2 parties here. Whenever you have an agreement or a contract, you have 2 parties. You have the lessee and the lessor. So the lessee is the person or the party who pays the rental payment and use the asset. So that's the lessee. The lessor is the party who owns the asset but lease it out. So in this framework, the lessor is the legal owner of the asset, but the lessee is actually the user of the asset. Now, I hope that this is quite intuitive. I mean, let's think about hiring a car. You would be, the lessee because you hire a car, you don't own it, but you pay for it and you can use it for a couple of days, whereas the owner of that car is the lessor. They own the asset, but they give the right to use the car to you in exchange for a payment. So that's a lease. So I thought it's fairly straightforward. Now, but I mean, to make it a bit more complicated, we have two different types of leases. We have an operating lease, and then we have a financial lease. Now, we are going to look at these two types of lease in great details, but in terms of financing for corporations, financial lease is more important because they are long-term. But again, as I said, we are going to look at each of these types of lease in greater details. And under the category of financial lease, we also be looking at two specific types, which is a sale and leaseback agreement and a leverage lease. Okay, so the first type, an operating lease. An operating lease. Essentially, it's a short-term rental agreement. So when you talk about operating, you're talking about a short-term lease. It is short-term and it can also be cancelled by the lessee. So the lessee, for any reason, they don't want to be part of the lease anymore, they do have an option to cancel. Now, with this type of lease, the lessor, I mean, always the owner of the asset, but in this particular case, they also bears all the risk of owning the asset, such as maintenance, repairs, the risk of obsolescence. If the asset goes out of fashion, it becomes obsolete, they bear all those sort of risks. The lessee does not bear any of those risks. They pay for the asset, they use it for a short period of time, and they return the asset to the lessor. Common examples: car. A lot of business cars are being leased. Computer and equipment, for example, at Deakin University, all these sort of equipments are actually leased. So all the photocopying machines, all the computers that we staff members use, they are all leased. They are all short-term lease. They are all operating leases. As opposed to operating leases, you have financial leases. Now, as I said, financial leases would be more relevant as a form of corporate financing because they are much longer term. Most often, the term of the lease is for the life of the asset. So it covers the life of the asset. Also, it's non-cancelable, so you cannot cancel it. Once you enter into the lease, that's it. You cannot cancel it. This is to be contrasted with an operating lease where you can actually cancel if you don't want the lease anymore. The risk of ownership, therefore, essentially has been transferred to the lessee because the lessee, the party who uses the asset, is responsible for all the repairs, all the maintenance, all the risk. So, I mean, if for some reason the asset or the equipment is out of order, then the lessee is responsible for fixing them. So they're responsible for all that. Common examples: aircraft. So most aircraft are financial leases, long-term, non-cancelable, that sort of thing, and long-term plant and equipment. So they are all financial leases. Now, as I said a bit earlier, there are two main forms of financial lease that we are going to look at. Very briefly, the first form is a sale and a leaseback agreement. So in a sale and a leaseback agreement, essentially the owner of the asset sells the asset and signs a contract to lease it back. Now, this form of lease is more common in real estate, not so much common in other areas. This is when the owner sell the house but then lease it back. So that is a sale and a leaseback agreement. Now, if you want to think about it, when you do something like this, this is essentially the same as borrowing money and use the asset as security. Because at the end of the day, what happens is, you have either way, whether you want to lease, or you sell and lease back, or you want to borrow money. At the end of the day, what happens is, it brings in some cash to you. So at the moment, you have a cash inflow. No matter whether you sell the house, or you borrow money, it brings in some cash inflow. But in the future, you have to make payment on an annual basis, or I don't know, or 6 monthly or whatever. But you have regular payments that you have to make. So you can see that these two alternatives are similar, whether you want to sell and lease it back, or you want to borrow money using the asset as a collateral or security. The impacts are essentially the same. And then we have a leveraged lease. Now, as the name suggests, when you have a leveraged lease, the lessor has to borrow money to buy the asset in order for it to be leased out. So that's where the leveraged lease, where the name comes from. The lessor has to borrow money to buy the asset for it to be leased out. Now, this is a very common structure of a leveraged lease. Now, I'm going to go through this with you. Now, with any other type of lease, you have two main parties here. You have the lessee, who makes the payment and who uses the asset. So in this case, you have the lessee here. And of course, you have the lessor. So in this case, this is the lessor. But the leveraged lease is a little bit more complicated than that. The lessor actually established or set up something that they call a special purpose entity. So it set up a separate entity that is only dealing with the lease. So it's a special purpose entity. Now, the special purpose entity is financed by two main parties, the leasing firm and some sort of lenders. So it's being financed by equity, and it's also being financed by debt. Now, typically, the leasing company would put up 20% of the equity. So they put in 20% of the purchasing price. The remaining 80% is being financed by a loan. So 20% from this, who essentially the owner of the asset to be leased out, or the aircraft in this case, and the remainder is being financed by a debt agreement. Okay, so I hope that is kind of straightforward up to this point. Two parties who finance the aircraft here, the leasing company put in 20%, and they take out a loan which accounts for 80% of the purchasing price of the aircraft. Okay, so once they've got the aircraft, they will lease it out to this party. Tends to be an airline, because an airline, they lease this aircraft so that they can operate. So as with any other lease agreement, when you lease, you make a lease payment. So that's where the lease payment comes. So the lease payment comes from the airline lessee to the special purpose entity. And this lease payment is usually made on an annual basis. So they have to make the lease payment every year. Now, once the special purpose entity got the lease payment, what do they do with it? Now, the problem is they have to pay the lenders, because essentially this special purpose entity borrows from these guys. They borrow 80% of the purchasing price. And when you borrow money, what do you have to do? Obviously, you have to make interest payments. Okay? So the lease payment here are mostly used to service the debt. So they're mostly used to pay off these guys. What do these guys get then? Obviously they don't get any cash flow. They don't get any cash flow because all the cash flow here, all the lease payment here goes to service the debt. So essentially, the leasing company, this guy here who put in 20%, they do not get irregular cash flows. What they get is they get a lot of tax shield. Are you familiar with the concept of tax shield? Not really? Now, because this guy here is the legal owner of the asset. So when you are the legal owner of the asset, you can depreciate the asset. Okay, so you depreciate the asset, it produces an expense, because you know that depreciation is an expense. It reduces your overall income, and therefore it reduces your overall tax liability. So a tax shield is something that reduces your overall tax liability. So that's what it means by a tax shield. You know, it's something that's shielding you against from tax. So anything that reduces your tax liabilities is referred to as a tax shield. So they get a lot of, they get depreciation and interest tax shield, because they get depreciation expense. They also have to make interest payment to this guy, the provider of the finance. So they also get interest tax shield, because both of these, depreciation and interest payment, are expenses. And if they are expenses, they reduce your income, and therefore they reduce the overall amount of tax that you have to pay. Now, so they get all this, they get all the tax shields. Now, so the tax shields here, I hope you understand that the tax shields are valuable. And in a lot of cases, they are treated as a cash inflow, because essentially it's a savings. It is a saving because it reduces the amount of tax that you have to pay. For example, if you don't have the tax shield, you might have to pay $100 in tax, but if you have $40 in tax shield, you only end up paying $60. So that's the definition of the tax shield. So anything that reduces your tax liability is a tax shield. So they get the tax shield that can be used to offset any other income that they might have. And at the end of the day, that reduces the amount of tax that they have to pay, so the tax shields are valuable. So that's the first thing that these guys get. They get all the tax shields that can be offset against other revenues to reduce their overall tax liabilities. The other thing that they will also get is at the end of the lease, they get back the asset. So that's the other thing that they get. And eventually, when they get that back, they can sell it. And whatever money that they can get from selling the asset is a cash flow to them. So having said that, I hope that you understand the incentives for each of these two participants. The first is the lender. They provide the debt, okay? They provide the debt. What do they get back? They just, they get back the interest payment. And also, when they sell this, eventually when they sell it, obviously part of the money. Now, the lease payment here, it obviously is used to service the debt. But if it's more than cover the interest payment, it can be used to reduce the balance on the debt as well. So essentially, all this lease payment here are aimed to repay all the debt holders and to reduce the debt balance. This guy, they are in it because they get the tax shield as the legal owner of the asset, and they also get the residual or the salvage value of the asset. So this type of lease is slightly more complicated than a common lease, but I hope that you understand why it has to be a leverage lease, because when you talk about assets that are very expensive like an aircraft, it's common sense that they have to take out a debt to finance the purchase as well. Before I move on to the next slide, the last point that I want to highlight in relation to this is the fact that the lenders here, when they provide the finance, it is actually a non-recourse debt, and of course I'm going to explain that. Non-recourse debt means that they only have a claim over the lease payments. Now, before I try to explain this, let's think about a normal situation, okay? Whenever a company borrows money, the lenders have a claim on the firm's cash flows, meaning that, the company has to repay all the interest payment. And also, if the company is not able to repay the interest payment, then the lenders can force the company into bankruptcy. So legally they can force the company into bankruptcy, and therefore the company might have to sell all the assets to repay all the debt holders. In this case, the lenders only have claim on the lease payments. If the airline here default on the lease payment, if they don't make payment, these guys, they cannot claim the asset of these guys. So that's what it means by non-recourse. So do you get the point? The point is they don't have any claim. So this guy here, they don't have any claim on the leasing company. They only have a claim on the airline lease or on the airline lease payments. Doesn't it is secured by the aircraft. So they have, it is secured by the aircraft, so they only have a claim on the aircraft when the airline does not make a payment. But if the airline makes all the payments, eventually the aircraft goes back to this guy. Does that make sense?
So if the company went bust, then they would get the aircraft, or they would get the revenue from the sale of the aircraft?
I mean, it's the same, isn't it? They get the aircraft, which they will sell, yes. So if the company doesn't, if the airline here doesn't go bust, if the airline makes all the lease payments, eventually the aircraft goes back to this guy, who is the legal owner. If the company goes bust and defaults on the lease payment, it goes here. So the aircraft goes to the debt holders. But having said that, in whatever situation, these guys have no claim on the asset of these guys. They only have a claim on the lease payment and also, you know, the aircraft itself in the situation of default. So that's what it means by non-recourse.
Also, with the lease payment, that the equity part gets attached to your lease payment. Well, wouldn't the lease payment have to go first to the special purpose entity, then to the equity party, and then the equity party pays the lease to the debt holder?
Yes. So the lease payment goes to the special purpose entity, then goes to the equity holder, and then goes here.
Okay.
But I mean, it goes through, yeah, but eventually the money ends up with the lenders. That's the point.
It needs to make that journey.
Yes, for them to claim the tax shield. Yes. Yep. Yep. Thanks for that clarification. Okay, let's move on to the next slide. Right, so now we've talked about the different types of leases. We talk about long-term, short-term, operating, financial, and so on and so on. So it gets to the point where we have to ask ourselves the question of, so why do we lease? What is it about leasing that are attractive? So there are a number of reasons why a company would like to be involved in a leasing agreement. Well, you know, there'd be sensible reasons, which we will discuss first, and then we'll talk about other reasons that are, you know, quite dubious. So the first is convenient, you know, especially if it's a short-term lease. Like, think about the situation where you go interstate and you need a car for a couple of days. What do? Of course, you're going to enter into a lease agreement. You hire the car for a couple of days. So it's convenient, so that you don't have to buy the car and sell it a week later. Doesn't make any sense, right? So it's convenient, and that's especially operating lease. The other thing which makes it quite attractive in relation to an operating lease is that you have an option to cancel. Now, obviously, you can cancel it, so it's attractive. I mean, when you do finance, you know that options are always valuable. You always want to have more choices than less choices. So all options are valuable. Well, I mean, some parties or some companies might find the maintenance part of it attractive, especially, you know, when you talk about Deakin University, for example, we hire or we lease all these equipments. So we don't have to worry about maintenance. You know, they come and provide maintenance on an annual basis, or we can call them up whenever, you know, anything goes wrong. And it can be, it is an advantage for us as a university, and also it makes a lot of sense because the lessor might have a competitive advantage in doing this sort of thing. They might have a lot of computers, so they might have a competitive advantage in servicing them. So that makes a lot of sense, a lot of economic sense, as opposed to Deakin trying to service all these themselves, because that's not our core business. Our core business is an education provider. So that makes a lot of sense. So the maintenance, you know, is attractive in that sense. It can also reduce transaction cost, and I think these 2 points are kind of related. Why can it reduce transaction cost? Again, if I can just give an example about us, the Deakin University. Now, obviously, we do need a large number of computers, but again, our main business is not in computer buying and selling. That's not our core strength. So to get another company who specializes in this sort of thing to do this can actually reduce transaction cost. Or I guess another example is if you talk about a lessor, and that lessor has to buy a lot of computers so that they can lease out. By buying a large amount of assets, they can get a discount as well. So, you know, there's an economy of scale sort of argument here. It can reduce transaction cost when the lessor can deal with a large amount or large quantity of assets. So it can reduce transaction cost, which is obviously attractive. Now, in some cases, the lessor can utilize the tax shields better, so that provides an advantage as well. And finally, this is probably more true in the US, but in the case of bankruptcy, lessor is actually treated better than lenders. You know, when the company goes into financial distress, it's not able to repay all the interest payment and all the lease payment. Okay, so it will go through the legal proceeding, and it will go to a court, where the court will determine whether the asset is essential for the operation of the company or not. If it is essential, then the company has to continue making lease payment. So before anyone else get paid, before any lenders, any employees or anyone get paid, the lessor will still get the lease payment because the asset is essential for the running of the business. So that's the first outcome. The second outcome might be the court might say that, oh, the asset is not essential for the running of the business. You can still run without this particular asset. If that's the decision, then the asset will have to be returned to the lessor. So the lessor get the asset back. And of course, there's also the third possible outcome, and that is the court might rule that the lessee and the lessor have, the asset is essential, but because the lessee is in financial distress, they might have to renegotiate the lease payment, and therefore the lessor have to accept a lower lease payment. But the first two possible outcomes, when we talk about, they continue to get the lease payment or they get the asset back, they are better off than lenders. Because see how they continue to get the lease payment, whereas the lenders, they do not get interest payment at all. So they, if you want, they kind of ranked above the lenders in this respect. So that's probably another reason why leasing might be attractive. And then, of course, you have other reasons for leasing, which, which one you talk about, you go like, really? And you put a question mark on it, so they're dubious. The first reason is leasing can actually make your book income better. How does it work? Now, for you to understand this point, you probably need to understand the difference between buying an asset and leasing it. Now, when you lease the asset, you make regular payments, but you don't own the asset. Okay? So you have an expense being the lease payment, but you don't own the asset. You get to use it, but you don't own it. When you buy the asset, you own the asset, obviously. You become the owner. Then you have to make interest payment, assuming that you borrow to buy the asset, but you also have depreciation expense. Because over time, the value of the asset will go down, you have depreciation expense. So we have two scenarios here. When you lease, the expense to you is the lease payment. Okay? When you buy, the expense to you is, first of all, the interest payment, because you have to borrow to buy. And the second type of expense to you is not a cash outflow, but it's an expense nevertheless, is depreciation expense. Okay? So one, you've got the lease payment. Over here, you've got interest payment plus depreciation expense. Now, usually in the earlier years of a lease, when you combine the interest payment with the depreciation expense together, they tend to be higher. than just the lease payment. So when they are higher, they make your book income look less attractive. Because when you lease, you only have, one lease payment. You don't even have to pay for it, right? So it looks more attractive because the expense that you incur in early years might be less. But as time goes on, then the lease payment become higher, and now the lease payment is fixed, but depreciation might go down over time, and when it's fully depreciated, you no longer have depreciation expense. So when you compare those two, then maybe eventually, you have more expense by leasing. But in the first few years, by leasing, you can actually reduce, not so much reduce, but you have lower expense comparing to the buying option, and therefore you make the book income look better. The book income looks better because the expense that you've got with leasing is less than the expense that you've got with buying. That's why it looks better. Now, I can see that you are looking at me quite blankly, so do you get this point? You do? Yeah? How about the rest of you? Do you get the point? Why it can make book income look better? Return on investment. Okay, so but it is dubious because over time it might not be the case. It might just look good for the first couple of years, but over time it's not necessarily true. So it's kind of dubious. The second reason that many people might say, which support leasing as a form of financing, is that it evades capital expenditure control, because usually in companies, whenever they make a capital budgeting decision, whenever they decide to invest in long-term assets, they would have to go through the process. They have to go through the chief financial officer to approve the funding, and so on and so on. Whereas with leasing, it doesn't involve a large initial outlay right now, so it might go past all those controls. So that's what people might say. But if you think about it, the fact that leasing can go past all these controls, does it really add value? Not necessarily. Not necessarily. So that's why it's kind of dubious. Okay, it might be convenient for managers, but it might not add value. And if it doesn't add value, then it should not be a very, sensible reason for leasing. Convenience is not, yeah, I mean, it makes make the job of the managers easier, but does it add value to the shareholders? And if it doesn't, then it should not be a sensible reason for leasing. The other argument is, well, by leasing, you actually achieve 100% financing of the asset because you don't have to pay anything. All of a sudden, you've got the asset that is ready to be used. But then the counter argument is, but if I borrow money and buy it, it's also 100% financing, isn't it? So it doesn't really preserve capital. It doesn't really provide 100% financing because I also have an alternative of doing that. So this reason alone is not a compelling reason for leasing. I mean, unless it's being backed up by other things, it alone is not a good reason for leasing. And finally, the use of off-balance sheet financing. Sometimes companies might find this quite attractive because when you lease, now again, it really depends on the accounting treatment of leases, and obviously different countries would have different ways to account for leasing. Financial leases increasingly are being reported in the balance sheet as well, because when you talk about financial lease long term, you almost assume the risk of ownership. So in many countries, like US, for example, they require a financial lease to be reported in the balance sheet. But in some other countries, they might be less strict in relation to the accounting of leasing, so they might actually not appear on the balance sheet because, legally speaking, the company does not own the asset at all. They only lease it. So they only have the right to use the asset, but they don't actually own it, so it doesn't go into the balance sheet. Some of them find that attractive because if you borrow money to buy the asset, that amount of borrowing goes straight into the balance sheet, right? So it's a debt, it's a loan, so it goes straight into the balance sheet, which effectively increase your debt equity ratio. When you lease, it doesn't appear in the balance sheet anywhere. So some companies might find that very attractive, but they still have to report it in the notes, the financial statements. So they can't ignore all these leases altogether. They might not go into the balance sheet, but they still goes into the notes of financial statement. So if you look at the balance sheet in conjunction with the notes of financial statements, essentially nothing will change. It's just where to report it. So again, that's why they would say that this is another dubious reason for leasing. So yeah, I mean, you've got a couple that are kind of sensible, kind of make sense, and a couple other reasons why, where you kind of, have a question mark when you talk about them. Now, let's move on to a more important discussion, which is how do you evaluate a lease? So this is when you say, if I'm talking about me as a lessee, then this is the question of, should I lease the asset or should I really be borrowing money to buy it? Which way is going to work better for me? Now, from the point of view of the lessor, the question that they might be asking themselves is, okay, if I have this asset that I can lease out, then how much should I charge? That's important, right? Because if I have the asset that I want to lease out, it's very important that I can determine how much I should charge the lessee, because at the end of the day, the lessor is in the business to make money. So they want to be profitable, so they have to determine the lease payment that they have to charge so that they can be profitable, so that they can stay in the business. So that's the type of question that the evaluation will help us answer. So let me recap that. From the point of view of the lessor, it would be how much do we charge the lessee so that we can be profitable. From the point of view of the lessee, should we lease or should we really go and buy the asset? Now again, when we do this sort of thing, we are looking at this independently from a capital budgeting decision. So we assume that when we get to this point, it has been decided that buying the asset is a positive NPV. Because, these are two different things here. So you've got, first of all, the investment decision where you say, do we need the asset? If we've got the asset, does it add value to us? So if the answer is yes, then the next step is, okay, how do we acquire the asset? Do we borrow to buy or do we actually lease the asset? So the point I'm making here is the evaluation of the leases here does not determine whether you should buy the asset, you should have the asset or not. That should be decided in the previous step. So when you get to this step, it's all about deciding whether buying is better or leasing is better. Okay?
Wouldn't it be the case that it's possible that by buying the asset, the NPV would be very, very slightly negative, whereas if you lease it, it would be very, very slightly positive?
Yes, it is quite possible that by leasing, you can rescue a project. Yes, you can actually rescue a project, because if you just look at the project per se, so just look at the project itself, let's say, look about whether we should buy an asset. Now, the NPV of that might be negative. And if it's negative, then you know what we do. We say we're not going to do it because it doesn't add value to the firm. However, if you look at leasing that asset, the value or the NPV of the lease might be positive and sufficiently positive that is more than offset the negative NPV, in which case, by leasing, you can actually rescue the project. Yes, so that's certainly a possibility. But I would like to highlight that whether you want to buy the asset or not is an investment decision, whereas whether you borrow to buy or you lease the asset is a financing decision. So that's the point that I'm trying to make. So these are two different types of decisions here. Of course, both of them are important corporate decisions, but they're different in nature. So that's the point that I would like to make. Okay, now let's get to the nuts and bolts of evaluating a lease now. Now, before we can do this, again, I need to highlight the difference between leasing and buying in terms of the possible cash flows. Okay, so when you lease, you have to make lease payment, obviously, or lease rentals. The lease payment, obviously, is an expense from the point of view of the lessee, so that's the first point. So it's an expense. It is an expense, but it comes with a tax shield because it's an expense. It increases expense, reduce revenue, and therefore reduce the amount of tax that you have to pay. So it's an expense, comes with a tax shield. From the point of view of the lessor, obviously that's income, right? Money coming in, so that's income. In terms of the depreciation, if you are the lessor, you are the legal owner of the asset, therefore you are entitled to all the depreciation expenses and therefore all the depreciation tax shield, if you're the lessor. If you are the lessee, you do not get that because essentially you are not the owner. You get the right to use the asset, but you don't own it. And finally, at the end of the life of the lease, usually the asset gets sold. And when asset is sold, I don't know whether you can remember this from your previous studies, but whenever you sell or you sell the asset at the end of the life, you either make a profit or a loss on the sale, depending on the price that you get is higher or lower than the book value of the asset. So I don't know whether you remember this. Now, if the price that you get is higher than the book value, then you make a profit on the sale because the book value said that this asset is only worth 20,000, but when you sell it, you get 35,000. So if you sell it for 35,000, you make 15,000 in profit. On the other hand, if you sell it for less than the book value, then you make a loss because the book said that this is worth 20,000, but you can only sell it for 10. Okay? Now, why is it important? It is important because it has tax implications. It has tax implications. If you make a profit on the sale, you pay tax on that profit. But if you make a loss on the sale, you reduce your tax, so it'd be a cash inflow to you. So all these things will be considered when you look at the cash flows associating with a lease. And what is a better way of looking at this than looking at an example? Okay, so we start with an operating lease, and then we move on and look at an example of financial lease as well. Now, can I just get you to look at the questions for, 20 seconds? Okay, so this problem, we value the lease from the point of view of the lessor. Okay, so the lessor tries to determine how much it should charge its client so that it will be at least break even. So that's the minimum lease rate. So the minimum lease rate is the lease rate at which the company will break even. So once you've got this minimum lease rate, you know that you have to charge something better than that for you to make money. Okay, so let's have a look. Now, before we look at the actual cash flows, let me talk a little bit about the depreciation schedule in the US. Now, essentially what this one is a schedule that allows for depreciation. So they have different categories of asset, and each category of asset can be depreciated using a certain schedule. And I mean, you don't have a choice as to what you want to depreciate it by. Each category of asset has a certain schedule attached to it. For example, if you look at a computer, it has a 5-year depreciation schedule, for example. So it's the regulation. Anyway, so this tells you the depreciation rate that you can take on each type of asset for each of the year. So most of the asset would fall into 5 and 7 schedules, 5 and 7 year schedules. So it tells you this is how much you can claim in the first year, second year, and so on and so on. So with the 5-year schedule, first year you can claim 20% of the purchasing price, and then you can claim 32%, and so on and so on. Okay? So I just want to show you this because it helps you work out the depreciation tax shield. Okay, so this is the cash flow. Now, the first thing is, of course, the cost. So again, we are looking at this lease from the point of view of the lessor. Okay, so the first thing that you do is you figure out how much does it cost you to have this asset. So what's the cost of the asset? Now, of course, it costs you 75,000 just to buy the asset. So obviously, is a cash outflow, negative 75. Now it also costs you maintenance and admin, which is about 12,000 per year. And so the first maintenance and admin amount due right now, so you have negative 12 in year 1. Now because this cost here, the maintenance and the admin here is an expense, there's a tax shield on that as well. Essentially because when you have this expense, it reduces your overall revenue, and therefore there's tax shield. How do you calculate the tax shield? Is this amount times by the corporate tax rate. Okay? So the tax shield here, the way that you get 4.2 is 12,000 times by the corporate tax rate, in this case 35%. So that's how you get the 4.2. And of course, it's the same for every year. Now, the thing that I want to make sure that you understand is the depreciation tax shield. Now, in general, the way that you calculate depreciation tax shield is so it's upside down, is it? Okay, so that's how you calculate depreciation tax shield. I don't know, you might know this before from your previous study, but I thought I'd just highlight it so you know where the numbers comes from. So you calculate depreciation tax shield by taking the initial cost times by the depreciation rate and times that by the corporate tax rate. Now, the first two here, when you times initial cost by the depreciation rate, it gives you depreciation expense. And when you times depreciation expense by the corporate tax rate, it gives you the tax shield, the depreciation tax shield. Okay, so now if you look over here, I'm going to show you how you actually get those depreciation tax shield. Okay, now again now in this case we actually use the 5-year schedule, so we're looking at this particular one. So that is our depreciation schedule. Okay, we need to work out tax shield. So as I said, the tax shield here is the initial cost 75,000 times by the rate, which is 20% here, times by 0.35. So that's how you get this figure. Okay. Similarly, if you move across to the second year, this figure here is 75,000 times by 32%, which is this one here, the second year, times by 35%, which is the corporate tax rate. Okay. Okay, so now, so you've got the initial cost, you've got all the maintenance admin, you've got the tax shield, and you've got the depreciation tax shield. Okay, so these are all the costs associating with owning the asset from the point of view of the lessor. So if you want to take the total cash flow at the end, work out the net cash flow, then you've got all these cash flows. At 7% cost of capital, the NPV works out to be, I think this is all in thousands, so it's $98,150. Now, try to put yourself in the situation or the position of the lessor. By having this asset ready to be leased out, you incur a cost which is about $98,150 in today's term. So that's how much it costs you to have this sort of asset available for hire, for rent, or for lease. So how do you actually charge your customer so that you can recover this amount? So the question becomes, how much do I charge my customer so that, you know, I at least get, in today's term, $98,150. Now remember that the lease payment is of the same amount every year. So the lease payment represents an annuity. So I don't know whether you can recall how to, you know, work out the present value of annuity and so on and so on. But at the end of the day, the problem boils down to calculating the present value of an annuity that makes it equal to this amount, 98.15. So that's your job. So I think that's the explanation that I've got on the next slide. But the thing that you have to keep in mind is the first payment is due immediately, because you always have to make the lease payment in advance. So the first payment is due immediately. So it's just not a normal annuity that we are talking about. We are talking about an annuity due, with the first payment due immediately. So the problem boils down to, let's find out that amount, whatever it is that we're trying to find out, that is an annuity due, that has a present value equal to that much when the interest rate is 7% per annum. So that's what we have to solve. There are two ways that you can do this. You can either use a formula or you can use a financial calculator. So let's have a look at both. Now, if you use the formula, this is the formula for the present value of an annuity due. I don't know whether you've come across this anywhere in your previous studies, but when you have an annuity with the first payment due immediately, the present value of that series of cash flow is given by this formula, where C is the amount of the payment, R is the interest rate, T is the number of payments. Okay? Now, in this particular scenario, you have all variables except for this one. So this one is the unknown variable that we are trying to figure out. So if I just pull that out on the other side, then I get the formula where C is equal to PV divided by that big denominator. So your job is just to put the number in. Once you've got the formula, the present value is 98.15. We work that out. Interest rate is 7% per annum. 7 payments altogether. That works out to be 7.02. again, this is all in thousands, so the minimum that you have to charge for you to break even is about 17,000. But then to make it a little bit more complicated, this amount is the after-tax amount. So that means that for you to get this amount after tax, you have to charge them something a bit higher, because this is after tax. So you need to get this amount after tax for you to break even. So before tax, you have to charge them even a higher amount for you to break even. So before we get to that, the second method that you can work this out is to use a financial calculator. How many of you have a financial calculator? So about a third of you have a financial calculator. So if you have a financial calculator, you can work this out a lot more quickly, because all you have to work out is you work out a PMT, where the PV is that amount, the I 7%, the N is 7. But the thing that you need to remember in this scenario is you have to put your calculator on the BGN mode to account for the fact that the annuity that we're talking about here is an annuity due. First payment due immediately. Okay, so when you do that, make sure that you put it on the BGN mode. If you don't, you would get the wrong answer. So just remember that you do that if you have a financial calculator. How do you adjust for the fact that this is after tax payment? If you want to work out the before tax lease rate, then you divide that by 1 minus TC, where TC is the corporate tax rate. So again, we assume it's 35%, so you have to go 17.02 divided by 0.65. So it turns out that for you to get $17,020 after tax, before tax, you have to charge your clients $28,180 per annum. So that's how much you have to charge. Now, this is the minimum that you have to charge for you to break even, obviously. So if you want it to be a profitable deal for you, you have to charge a lease rate which is higher than this amount. If you don't, then it's negative, and it's a negative NPV sort of thing to you. You don't make any money out of this if you charge anything less than $28,180. Is there a question up to this point? Okay, all right, I'm going to move on. Okay, so now let's move on to the second example where we consider the let's see position. So now we talk about the let's see and we talk about financial lease. Now from the point of view of the let's see, the decision that they have to make here is, do we lease or do we buy by borrowing? So that's the decision that they have to make. So the framework is, so again, this is an oversimplified example obviously, but anyway, it highlights all the main features of a financial lease anyway. So you've got a bus, it's $100,000 if you want to buy it. It has 8 years life, and you can lease it at $16,900 per year, and then you've got the borrowing rate of 10% per annum. Should we buy or should we lease the bus? So what's the conceptual problem here? The conceptual problem is you have two different scenarios. If you lease and if you buy, okay? So for you, the approach for us to work this out is we assume that we're going to lease this particular bus, and then we're trying to work out the NPV of the lease, and if the NPV is greater than 0, then leasing is better than buying, and therefore you lease. If the NPV is less than 0, then leasing is not as good as borrowing to buy, and therefore you're better off by, borrowing and buy the asset. So that's the framework. And also, we are going to focus on cash flows and discounted cash flows. So identify the cash flows, and we try to discount them to the present so that we can work out the NPV. Now, in this particular case, If the company is to lease the asset, then it will save the cost, right? Like it doesn't have to pay for the cost, so it saves $100,000. But it doesn't get any depreciation benefit either. Also, it has to make a lease payment due at the beginning of each year. So every year it has to make a lease payment of $16,900. But again, all these lease payments are tax deductible. Now, for simplicity, this example assumes that, let me have a look at the question again. Okay, so it doesn't mention anything about salvage value, so we just assume that it doesn't have any salvage value. Okay, no salvage value, it's fully depreciated and there's no salvage value. That's the assumption for this particular question. Okay, so let's have a look at the cash flow. Now, this table set up the cash flows of all the items that we kind of discussed in the previous slide. So we've got the cost of the new bus. If you lease, you don't have to pay for the cost of the bus. So that's why it has a positive sign. Okay, so it's 100 positive because you save that amount. But because you lease, you don't get the depreciation tax shield, so it has a negative sign. Again, how do you work this out? You work this out by taking the 5-year schedule, depreciation schedule. So you've got the first year, 100, times by the allowable depreciation rate, which is 20% for the first year, and times it by the corporate tax rate, which is 35%. So that's how you work out this lost depreciation tax shield. Okay? And then similarly, you've got, other tax shield for other years. So again, initial cost times by allowable tax depreciation rate times by the corporate tax rate. Then you've got the lease payment. Obviously a cash outflow to you, so that's obvious. But you've got the tax shield to come with it as well. So that's all the cash flows that you have to consider in this particular case. So typically, these are the cash flows that you have to consider when you look at a lease, when you evaluate a lease. You've got the initial cost, you've got the lost depreciation tax shield, you've got the lease payment, and the tax shield on the lease payment. In some cases, you have to look at the salvage value as well. And not just the salvage value that you have to look at, you also have to look at the tax consequences of salvage, whether you make a profit or a loss on that, and the amount of tax that you have to pay accordingly. I said that we're not going to have a break, but I do feel that you have problem concentrating, so can I just give you 2 minutes and then you just go and stretch a little bit, and then when we go back we try to focus a little bit better.
Why are you using like 5-year depreciation for like 8-year contract or bus?
less, or can just do it anyway? Okay. Okay. Yep. Yep. Okay. I thought I'd invented something, but I guess not. Every time, every single time. Yeah, that's true.
All right, everyone, can we resume the lectures, please? Okay, during the break, I've got 3 identical questions, and the question is, why do we always use the 5-year depreciation schedule? So obviously, I didn't do my job very well. I didn't explain it clearly enough. The schedule that you use depends on the asset type. So if it's a bus, if it's a limo, the allowable depreciation schedule is 5 years. So it depends on the asset type. It does not depend on the length of the lease. So if it's a bus, it's always 5 years because, you know, that's the provision for a bus. If it's another asset, it's always 10 years and so on and so on. Now, for the purpose of assessment, we'll be more specific. We'll be more specific. We might say that the asset has a 5-year depreciation schedule, or so on and so on. Or we use straight line depreciation, so you always know exactly what you have to do in relation to calculating depreciation. Okay. Okay. So once we've got this cash flow, now I want you to have a quick look at these cash flows. Now, you've got an inflow in year 0, but after that, all cash outflows. So, if you just glance at it, on the surface, these cash flows pattern are very similar to the pattern of cash flows when you borrow money. Because when you borrow money, essentially, you've got money coming in right now, but then you have to start making payments, and therefore you've got cash outflows. So you've got negative cash flows coming out every year after that. So for this reason, many people refer to this approach of evaluating a lease as an equivalent loan approach. So what is an equivalent loan? An equivalent loan means a loan that gives you all this cash outflow. So in other words, the question that you ask yourself is, if I were to borrow money and this amount of money results in all these cash flows in terms of debt servicing and principal repayment, what is it amount now? So you can answer that question by just, discount everything back to present. So if you discount all this cash flow back to the present, the amount that you get is referred to as the equivalent loan. Now, I know that the concept might be a little bit abstract, but what we are trying to say here is that instead of having a lease, if you were to borrow money, then how much would that be given all these cash outflows? So the value of the equivalent loan is simply the present value of all these cash flows. So that's the value of an equivalent loan. Now, but to me, I thought in terms of evaluating this, a much easier concept for you to understand is the NPV concept, because net present value is something that you are familiar with. So instead of worrying about the equivalent loan, why don't we just work out the NPV? So if we just discount everything, add them together to work out an NPV, and if the NPV is greater than 0, then leasing is better than buying. Less than 0, no, leasing is not good enough. Therefore, you better go and borrow and buy. Okay? So in terms of the calculation here, I only need you to do the NPV, just being able to calculate the NPV, but at the same time, I hope you appreciate the concept of an equivalent loan. So the value of the equivalent loan is simply the present value of all these cash flows from year 1 on. Okay, so let's calculate the NPV of the lease now. And of course, I feel that I don't need to go into a lot of explanation regarding the calculation of the NPV, because that should be something that you know like the back of your hand, because I'm sure that in your studies you've been doing a lot of NPV calculations. The thing that I want to point out, however, is the fact that when you borrow money, it comes with an interest tax shield. So the appropriate discount rate is just not the cost of debt, but it should be the after-tax cost of debt. So try to remember this. When you do an evaluation of a financial lease, when you compare the decision of to lease or to borrow and buy, always use an after-tax discount rate. Because when you borrow, it comes with a tax shield. So that's why you use an after-tax cost of capital or cost of debt. So instead of using 10%, which is the nominal interest rate, you use 6.5%, which is the after-tax cost of debt, to reflect the fact that if you borrow, effectively you only pay 6.5% because of the tax benefit that debt provides. Okay, so once we establish that, the rest is just a simple NPV calculation. By now, you should have developed a system for you to calculate NPV, whether you do it manually using just a scientific calculator or a financial calculator or the table. I don't know what you use, but you should be able to work this out rather quickly. Now, as it turns out, this particular lease has a negative NPV. 700 in the negative. So it means that lease is not as good as buy. So you're better off buying than leasing. So you're better off borrowing than buying. Now obviously you can see that the thing that has a very important impact on your decision is of course that. That has a very important impact, because depending on how much you can borrow, leasing can be good or can be bad because it acts as a discount rate. So other things being equal, the lower The lower the interest rate, the more likely that you're going to buy, to take advantage of that lower interest rate. Whereas the higher the interest rate, you are more likely to lease. So other things being equal. So assuming that everything stays the same, that's the logical consequence. Okay, so we've done the evaluation from the point of view of the lessee. So from the point of view of the lessee, it's a negative NPV thing. So the lessee has no incentive to do this. If we look at the whole scenario from the point of view of the lessor, you recognize that if both of them pay the same corporate tax rate, right? If they both pay the same corporate tax rate, then every cash outflow to the lessee is an inflow to the lessor, right? Because you talk about two parties here. Let's say the lessee makes a payment to the lessor, so cash outflow from the point of view of the lessee, but cash inflow from the point of view of the lessor. So can you see that they always have the same amount of cash flow, just opposite sign? So negative to one, positive to the other. So if that's the case, if we look at exactly the same lease, then what would happen? Now, the value of the lease to the lessor would be positive 700, because every cash flows are exactly identical except for the sign. One is positive, the other one is negative. So because of this, if both the lessee and the lessor have to pay the same amount of tax, and if we just ignore all the competitive advantage in terms of costing, then leasing is a zero-sum game. Zero-sum game in the sense that if you add the NPV of the lessee to that of the lessor, you always get a fat zero number. Can you see this? Because, I mean, the cash flow is always offset. The cash flow is always offset. So if one party gets a positive NPV, the other party will get a negative NPV of exactly the same amount. So if you add them together, it's going to be zero. So if both of them pay the same amount of tax, it's going to be a zero-sum game. No one wins. And as a matter of fact, if they pay the same amount of tax, no lease is going to be ever taken out. Because when it's a positive NPV for one, it's a negative NPV for the other, and the transaction will never take place. Now, the reason that the leasing market exists is not all people pay the same amount of tax. Now, obviously in Australia, then all companies pay the same corporate tax rate, so the advantage of leasing must come from other sources, things like comparative advantage in buying and disposing asset, as I said right at the beginning. Like, unless you have comparative advantage in buying, you can buy them a lot cheaper, then yes, that provides a benefit, and therefore leasing can exist. For example, if the lessor buy is $50, but if the lessee has to buy the same asset, it's $70. So I guess the point, I just get lost in what I'm trying to explain here. I'm trying to explain that the reason that the leasing market exists is because the lessee and the lessor pay different taxes. So they have different tax brackets. This is also a reason why cross-border lease can be quite popular, because if the lessor and the lessee are in two different countries, they pay tax on two different systems, and they're unlikely to be the same. And if they're not the same, then leasing can be a positive sum game, meaning that it can be a positive NPV thing for both the lessee and the lessor. And of course, you know that a lease transaction can only take place if both of these parties get a positive NPV. Because if you don't get a positive NPV, you will never do it. So you get a lease contract only when both the lessee and the lessor get something out of it. Okay? And differences in tax is one important consideration, or one important factor that's responsible for the fact that both of them can actually get a positive NPV. Okay, this is an illustration. Now, remember that previously, when we looked at exactly the same example, we've got the NPV for the lessee to be negative 700. Exactly same example. So if you assume that the lessee paid no tax now, the NPV becomes 820. Okay? So the lessor gets 700, the lessee gets 820, and therefore it becomes very attractive to both of these parties. Now, of course, this example takes a very extreme case, which is when the lessee paid no tax. It doesn't have to be no tax as long as it's less than the other one. So as long as less than 35%, then you would probably have a positive NPV for both of them.
What if there's no tax and there'd be no tax here?
Correct. That's what happened. So this is what happened in this particular scenario. If you look back, there's no tax shield at all. So all remains is the lease payment, which is the cash flow. No depreciation tax shield, no interest tax shield. So that's why the cash flow is 16.9, and that's it, which is the lease payment.
Okay, so there's no tax shield or tax payment.
No, there's no tax shield, but in a lease, the lessee still has to pay the lease payment, which is the 16.9 in this case. So that's the only cash flow that remains. All other disappear because there's no tax. Okay. So again, it's just an illustration, and different tax rates drive the leasing activities. I don't think I'm going to go through these two slides because I think this is the type of thing that works better when you actually read it and try to understand it rather than having me reading them out to you. But essentially, this tells you the steps that you need to go through in a lease evaluation problem. So yeah, I think this is something that you better sit down and try to read through. They're quite self-explanatory, so I don't think I need a lot of explanation on that. But of course, if you have any problem understanding any of those, I'm very happy to talk to you. Okay? Now, I've got another example here. But I'm not sure whether we have enough time or you have enough patience with me because I understand that the material is quite dry. Now, it's similar, so it's also on a financial lease, and then, it has the same sort of information. The difference is that the way that the aircraft is being depreciated here. So the way that the aircraft is being depreciated here is at 15% per annum. So that means that every year it's depreciated at 15%. Different corporate tax rate, 30%, and the other thing that's quite different is the fact that there is a salvage value. Okay, the market salvage value for the aircraft at the end of the lease is expected to be the same as its book value. So the salvage value is the same as the book value. So the salvage value has to be taken into consideration, but because the salvage value is equal to the book value, you don't need to take into account the tax consequences because they don't make any gain, they don't make any loss either in the salvage of this asset. Now, I would love it if you can just go home and attempt this. I give you the result, and if you want, I can put up the solution on DSO as well. But the result is 22.04 million. So the NPV of this lease is positive 22.04 million. So I would love it if you just go home and try to give it a go, possibly tonight when everything's still very fresh in your mind, and then I put up the solutions to it. Right, so again, in finance you probably find that we want to talk about a perfect capital markets. A lot of things, when we try to understand a lot of theories in finance, we talk about a perfect capital markets where there's no tax, no transaction costs, and so on and so on. And it would be going like, oh, that's so silly because we know that the markets are not perfect. But the reason that we like to assume a perfect capital market is so that we have a simple model which we can modify when we, release all the assumption about perfect capital market. So with leasing, it's the same. So if the market is perfect, then obviously probably it doesn't make any much difference whether you lease or you buy. But obviously the market are not perfect, therefore the consideration becomes important. Now, some important factors here. The first one I kind of touch on, different companies pay different tax rates. Now, in Australia, it's not the case because in Australia, all companies pay the same corporate tax rate. But I mean, if you talk about different companies in different countries, then obviously they pay different tax rates. Or companies in countries where they have a progressive tax schedule, meaning that the more income that they have, the more tax that they pay, the same way that we pay personal income tax here, then the effective tax rate that they pay are quite different. So different company tax rate. The cost of capital might be different as well, depending on a lot of things, but mostly depending on the risk of the company. So the risk of the company will determine the cost of capital. And again, also transaction cost. Who has a competitive advantage in the buying and selling of all these assets? So these factors are very important drivers of the leasing market. Because of these factors that we have the lease market. So when is it that leases can be a positive sum game? It can be a positive sum game if the lessor and lessee have different tax brackets or tax rates. We kind of cover this. Or it can be because the lessor and the lessee have different cost of capital. Now, if we talk about like other things being equal, if I just relate you back to the example that we've got, where you have the lessor has positive 700, but the lessee is negative 700. Now, they have the same amount because they have the same cost of capital. We discount the cash flows by the same discount rate. If the discount rates are different, then chances are both of them might be positive. So different taxes, different cost of capitals account for positive sum game in leases. The third point, I think I've kind of touched on as well, and that is when the lessor has competitive advantage in buying and selling the asset. So they might have competitive advantage in buying. They might be buying a lot of things in large quantity, and therefore they get a discount. They know the market better, so they're more likely to get concession even when they buy or sell. They might have might have competitive advantage in maintenance. We kind of touch on this. So that also accounts for the activities in the leasing market. Now, just to close the lecture, I've got, I don't know, 5-10 more minutes left. I'm just going to go through a couple of characteristics of the assets that make them more likely to be leased than the others. So you know that not all assets can be leased. Some are more commonly leased and some are not so commonly leased. So what are some of the characteristics that determine that? Pretty much there are four main characteristics. I've got a slide for each of them. So the first one is sensitivity to use and maintenance. Generally speaking, when you lease an asset, you don't have a very strong incentive to care for it as much as when you own it, because essentially when you lease it, it's still not your own, not your own asset, So you don't have an incentive to care for it very well. So that's why if the asset is very sensitive to use and maintenance, then it's less likely to be leased, because the lessor know that the lessee are not going to take a very good care of the asset. So if it's something which is extremely sensitive to care and maintenance, if you don't, provide a lot of care, it stops working or it doesn't work as well as it should, then it's likely to be leased as opposed, it's less likely to be leased. So sensitive to use and maintenance, less likely to be leased. The second characteristic is how specialized the asset is. If you just talk about a photocopying machine, it's generic. Every company would have, I don't know, some more or less the same photocopying machine. So it's a generic sort of asset. If it's generic, then obviously it's more likely to be leased. There's a bigger market if you talk about photocopying machine. But if you talk about a very highly specialized machine that is used, say, in the pharmaceutical industry to produce a very particular type of drugs, then obviously it's less likely to be leased because the market is really small, like not too many people have demand for that type of asset. It's too specialized. The lessor might not have a competitive advantage in dealing with that sort of asset just because it's too specialized. So if that's the case, it's less likely to be leased as well. If that's the case, the company is more likely to buy it because it's too specialized. Generally speaking, generic assets, things like computer, photocopying machine, car, those generic, and they are more likely to be leased. Things that are highly specific, specific to the company, specific to the industry, they are unlikely to be leased. They're more likely to be bought by those companies. Transaction costs, if there's a lot of transaction costs in the purchasing or in the selling of the asset, they're more likely to be leased because this relates back to the point that I said about how lessors are more likely to have a competitive advantage in dealing with these sort of things just because they have more experience. They've dealt with this sort of asset all their lives. That's what they do for a living, so they just have more competitive advantage. So the higher the cost, the more likely that you will lease it as opposed to going through the whole process to buy that yourself just because of the high transaction cost. And finally, comparative advantage, I think I kind of touched on it on a number of occasions. If they have a comparative advantage either in buying, whether they can buy, if the lessor can buy more cheaply, or if the lessor can sell the asset for a better price, then obviously the asset is more likely to be leased as well. So I think that's all I have for today. Thank you so much for your attendance, and I hope to see you next week.
Some problems to doing this online test too.
Have you emailed Michael?
Yeah, no, like HOA.
That's me. You need to email Michael because Michael looks after all the inquiries for test 2. From next on, I'll be looking after that.
Can I have his email address or you can forward my email?
Have you emailed me?
Yeah.
You have, right?
Yeah.
When?
Time is this month. 20.
Oh, okay, so like a week, 10 days ago.
Yeah.
Oh, 6 days ago.
Yeah.
Okay, if you have, I forwarded all the messages to him. Yeah, I forwarded everything to him. So he'll get back to you eventually because he's overseas, but he'll be back.
Okay. So you still are very sure I can have a second chance for the online test?
It's unlikely that you get to do the online test, but what we might do is we might add the mark to the next 2 tests. You know what I mean? So instead of your next test being 2.5%, it'll be, I don't know, 2.5 plus. Like, we spread it, so it'll be 3.3.
Yeah, but same 5 questions.
Same 5 questions. It just carry more marks for you than another person.
Oh, okay, then.
Okay, but Michael will get back to you. Yes. Okay, he should start with the
Yeah, because I check on the DSO and I think some students with the same problem as me.
Yes. So yeah, he get back to you.
Okay, then. See you.
Oh, are you the person who, you click on that and it said assessment is already in progress? Because I forward that message to DSO and they say that one of the problems might be it opens up another window. Have you checked that there's another window open
No,
up?
I restart the computer. to sure they will not another windows for the test.
Oh, okay. Then I don't know.
Yeah, since that the timing is still running.
Yeah, then I don't know what the problem is.
Okay,
But Michael will get back to you.
Okay.
They also said that's why depreciation in the first year and the last year tend to be lower.
I just have one question about the employee. I tried to calculate on my phone, but I kept getting minus. That's a 9,000.
Yeah, it's almost 9 point something.
Calculation because this is a pretty good minus 9 so this is minus
So you get a different,
yeah,
you get a different number?
so I think it's 600. Yeah, I thought maybe we're missing a calculation. Maybe we need to add something up.
But I mean, it's still that.
Yeah. Minus this plus one. Yeah, no, I thought maybe we did something.
Yeah, I'll give you a quick look.
Did you save it?
I saved it.
I want to see.
This is my. Yeah, I know. My little. Yeah. So I put in all the input 6.5% every month. So I rigged this formula myself, and you got negative 9.
Yeah, that's what I got as well.
Yeah.
Alright, thanks. Have a nice day.
So, yeah, let you go.
Yeah, let's go. No, let's walk with me. Walk with me.